Give us a sense of what you saw in the markets this week. As I say, the equities did really, really well, despite the fact they had a little headwind from a couple of the big tech companies.
Yeah, David, thanks so much for having me. And earnings season are about 50% of the way through, and it's been good. I mean, not great like we saw in Q1 and Q2, but 85% of the companies beating, so it's still above kind of the average. But I'd say the one big caveat we would flag is around company guidance, and a lot of that had been focused around a lot of supply chain issues and other impacts that pricing power initially, for the companies that can do it should be able to work through. But that is something to continue to look out for as we go into Q4. I think for companies that did miss, they have gotten hit reasonably hard. And so while we've seen the market react overall well to earnings, on average 4% down for companies that aren't meeting expectations. And so from our point of view, kind of healthy spread between winners and losers is a really good opportunity for active management and really starting to dig into some of the differentiation that we expect to see going forward.
So, Katie, let's talk about tech for a second, because we had so many big tech earnings out this week. A lot of them positive, but then we had the Amazon and Apple, which were really a hiccup, one of which was really supply chain in the case of Apple. The other was really more labor in the case of Amazon. Did it tell us anything in the longer term about big tech driving this market, which it has done for so long?
I know they did disappoint, but I just to take Apple for a second. People are disappointed, but they should remember iPhone sales were still up 46% year over year. So there still is good growth there, but expectations, of course, were for 53%. I think what you've seen there is very specific to what you just said, and maybe we can unpack it later, which is supply chain issues and also labor. And we don't think that that's going to. We think that's an issue that they can actually get over. Other interesting trends that we're focused on in tech earnings generally would be I could maybe touch on payments as an example and what's happening in the finance space. I'm really interested in the third quarter of this year as being kind of the first quarter that we've seen the potential for how much disruption we think is coming at the financial sector. Just for context, there's $16 trillion of market capitalization in financials compared to, for example, $14 trillion of market capitalization in the internet. And we are on the precipice of seeing major disruption across that whole sector. We saw some big losers get printed in the third quarter. So the merchant acquirer sector, if you look at the earnings of those companies, they disappointed a lot because they're getting disintermediated by companies like Shopify or Toast, for example, that are offering those services, better product, better pricing. And then on the winning side, and I'll end my comments there, but in terms of winners in this space, you would look at buy now, pay later, which, as my husband says to me, isn't that just the same thing as a credit card? What's buy now, pay later? But effectively, what it's great product for the millennial and Gen Z consumer. You basically pay on deferred payments. There's no late fee. And there's actually no interest charged either. And the reason it works is because they charge the merchants a higher fee. And those merchants tolerate that higher fee because they're getting a bigger addressable market and higher volume. Now, of course, we need to go through a credit cycle to see if this is a durable business model, but they're taking tremendous market share from traditional banks.
So, Kate, apply your advocacy of active management in this marketplace. Apply it to tech. How does that work? Where do you look for real opportunities in tech? What do you tend to stay away from?
Yeah, I mean, I think when you're talking about tech too, I think it's important to focus on both public and private markets and just where you're starting to see disruption. I think Katie often will focus on some of the trends and the themes and the structural shifts that we're seeing. And I think that's where, again, active management and really being able to dig into some of the disruptors and the different ways that we're seeing companies be able to change the way that we're operating. Often is being done as much, and I'm sure Katie will combat this a bit in the private markets as much as we're seeing it in the public market. So I would say from a tech perspective, we do try to focus on across kind of everything from VC early stage all the way through to the public markets. And I think that the thing that we all have talked about, it's like now like tech isn't a sector, like it's in every kind of an industry in every company. And so really thinking through, where some of the big shifts are going to be and where the investment's happening. And that's where I think that active management element of it and really understanding what management teams are doing and getting it right is so critical.
So as an active manager, Katie, I would assume you go company by company, but are there some categories, and let me specifically address one, B2B versus B2C in tech. For example, this week we saw Snap really take a hit because of some privacy changes made by Apple. Do you get a little nervous about possible regulatory problems in the B2C area? That's for Kate.
Oh, sorry. Yeah, in the B2C area, yeah, I think a couple things. And from regulatory perspective, and changes that are happening in lots of ways, I think it is healthy, for us to be challenging and thinking through some of the shifts that this type of change in the way that we're operating is impacting how we live day to day. And so while there are challenges that we expect these companies to have to deal with, the fact is that they're going to be around, and the profitability and the growth that we expect from them is going to be there. And maybe you end up getting some more competition that comes out of this, and you get some of the less known mega tech companies get a bit more of an inroads as you see a little bit more regulation and challenges coming through. And so we look at it as healthy kind of progress that in terms of having some of that come into the discussion.
So, Katie Koch, one of the things that we've talked about a lot is what's going on in Washington, or not going on in Washington right now, but they have some sort of a framework, whatever that means. And I think a lot of corporations breathed a little bit of a sigh of relief that the tax part of it didn't go farther than they thought it was going to go, right? Do you take that into account with respect to future earnings projections?
Yeah, of course. I mean, we understand that the tax burden, which went down, is going to shift back upwards to support all of the spending that we need to do, some of which is really important in this country to address systemic issues around income inequality, et cetera. And we are able to bake that into the margins of companies. And while we expect to see, some hit from that and also a hit from supply chain resilience, which we'll talk about later, we still see tremendously strong demand and actually a path forward for companies to continue to generate earnings. The one thing I want to comment about markets here is we've had the best October. What was it you said?
6 years.
6 years. Yeah. So we got markets up 25% year to date. We've had a lot of strength out of equity markets, and people always ask me what's going to be the catalyst, like what would make things inflect. And I would really point to if we get a troubled earnings season, because that's what's supporting markets at these valuations. And so yes, being able to predict margins and what's the impact on that's really important.
Okay, prediction, Kate El-Hillow, let's go. Last one to you. What about earnings going forward? We've had a really good run on it. What are you looking at in the fourth quarter into 2022?
Yeah, I mean, we do expect a slowdown in the growth that we have been benefiting from, but we're still constructive on the cycle. We think a lot of the supply chain issues will continue into 22, but they're going to start to dissipate, and maybe you'll get a bit of a demand balance out from the consumer, but the consumer is still healthy. Companies are flush with cash, and we're seeing more indicators of companies actually investing. And from that perspective, we feel good about kind of where earnings are, but it's certainly going to taper off from what we saw in kind of the 4 quarters coming out of the crisis. And you're starting to see that with this quarter, but we're still constructive going on to next year and think companies will be able to kind of survive through kind of any inflationary pressures. And we're still much in the transitory camp. So we think that this will temper, but it's still going to be a positive place for equities, and earnings are going to help drive that.